Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go, generally related to commodities, financial topics, and wealth building. Let's dive in there. Let's see what's going on, and I'll share my opinions. You can reach me or follow me at finding_finance on Twitter, or you can join our community and/or finding-value.com, where I dive deeper into individual companies, sectors, topics, ratios. I have question and answer sessions on the weekends, midweek updates on Wednesdays of what I think looks good, what I am doing in my portfolio. You can see all of my purchases and also my portfolio. We still have a discount coupon code going on, LEAP, LEAP. Starting at nat gas, the use of air conditioning is expected to soar as incomes and temperatures rise. This is from 2021, looking out all the way to 2050. And you can see China and India have quite a bit of growth ahead of them in terms of air conditioning. That is electricity being generated, and natural gas is one of many things that generates electricity. Obviously, you've got solar, you've got nuclear, and then you've got wind and coal. And coal is going to be a big driver too. And I've got another graph below with coal consumption. Guyana quarter 1 production surged 70% from a year earlier. That's enough to supply almost 1/5 of the global demand growth this year. So that big surge off of Africa of 70% can supply about 1/5 of the growth for this year. So that's Exxon and Chevron output booms in the world's hottest oil patches. Output is booming in Guyana, Permian Basin for both companies. The U.S. majors will extend lead over Shell, BP once deals close. Michael Gayed, he says, lumber prices have completely collapsed relative to gold prices. The drop in lumber clearly warned about housing starts, which tumbled by 14.7%. We suddenly find ourselves in what could be a substantial change to housing market activity and demand. What gets me interested, in what is interesting here in this setup is I do think this setup is different than previous setups. So the things that people generally track, I'm curious to see if they still hold true. Is the economy weak because lumber prices go down from housing starts, or is affordability driving it, where the debt and how much debt we have to roll over is really driving interest rates? Historically, it's been the housing market that drives interest rates and the inflation from the mortgage lending. Obviously, affordability is poor, and obviously, mortgage lending is down, and so is home sales. But what if the fiscal side is more of a driver? Do we still get this? Do we still use the same lumber to gold ratio under different market conditions in an increasing interest rate environment, which is being driven maybe different than previous markets of the past 40, 50 years? I don't know what the answer is there, but I'm not so quick to say that lumber prices have collapsed. And most of the recessions come, again, from real estate crashing, but it's not crashing from an oversupply state. It's like it did twice: early 70s, mid 70s, early 80s, 1990, 2008. Those were all oversupplied, hyper supply phases. We're not in a hyper supply phase. So the question is, if you don't have a quote credit crash from the housing market, if it just slows down, we would see it in construction workers and all these other things. And we haven't seen that yet. Not yet. So we'll be watching it. We'll be watching it. Corey says, if you feel like a financial mess, you're not alone. I was once where you are. From 260,000 of debt to a millionaire, here are the actions I took to change everything. She wrote everything down. My wake-up call was seeing that 16,000 was going toward interest every year. This was one home pay at the time. List your debt, calculate your interest, track your income and spending. She leaned into her 9 to 5 job. She realized more income could make my debt problem go away. I became a certified accountant. I increased my skills. I volunteered for more projects. I did multiple roles helping to fill gaps. I got lean. I made it a game to see how little I could spend each day. I stopped eating out, stopped hanging out at bars. I started enjoying free activities. I stayed consistent. I stopped quitting everything I started. I got a part-time job on the weekends. I created a plan and executed it even when it was hard. I did this for 5 years until the debt was paid off. I was trying to pay off debt, interested in building wealth. So I think a lot of this is good. I can give you my example. My example is I never got into debt. So I avoided debt like the plague when I was younger. I went to a school that I could afford. I got in-state residency after my first year of being there. I did go out of state. And then it was incredibly cheap to go to school there. It was a California school. And I never got into debt. So a lot of people say, oh, I can't believe the strength of this person who quits their drug addiction. All I'm going to say is I never got the drug addiction. I avoided all the debt, so to speak. I never got addicted to the debt. I avoided it at all cost and completely went right by it. I do that with a lot of things. I make things look very easy, make life probably look a little bit easier. It's because I just avoid all the stuff that is bad for you. And that's where I'm trying to make the best decisions. Your life, when you go through life, all your life is an accumulation of the decisions that you've made throughout your life. And if you want to go somewhere 10, 20, 30 years in the future, and you don't want to go down the right-hand path, and maybe you want to go down the left-hand path. So are the decisions that you are making day in and day out supporting the left-hand path that you want to go down? And that's really all it is. I also am probably a little bit different than other people. I don't care about hierarchy. I don't care about status. I can give two rats butts what people think of me necessarily outside of the people I care about. But everyone else, the average Joe or the next door neighbor, I really don't care. And a lot of that, I think, drives decisions that I do much differently than maybe other people because I don't care what other people think. Here's the average property tax rate, and I do think that this is somewhat misleading, and that's why I wanted to go over it. Texas is 1.6%, Florida is 0.91%, and California is 0.71%. The average full coverage auto insurance, Florida is $3,244, California is $2,663, Texas is $2,205, and then the average median household income, $84, $61, and $61. It says, turns out Florida and Texas aren't so much cheaper after all. Well, there's certain things here. So Colorado, the average property tax is 0.57. California, if you buy your house at a bottom, your property taxes, I don't think, can go up more than 2% a year. That would be ideal. I had a buddy where his mom purchased like 3 or 4 homes right at the beginning when I started college in 1999. She bought a whole bunch of homes and she was renting them all out. Those homes are like $1 million each. She bought them for about $200,000, and her property taxes on those homes are like $2,200 a year each. $2,200. Then you've got the average full coverage auto insurance. I don't have full coverage. I drive old cars and I only have liability only. That's another way that I save money. So I live in a state that has reasonable state taxes, reasonable sales taxes. They have very good property taxes, probably the lowest five, 6 states. We're probably number 5 or 6 or something like that in Colorado, I'm guessing. And I have cheap insurance because I drive cheap cars. And then I don't, not going to talk about my average, my household income, but um, when I looked at all the states that I wanted to look at and potentially live in, obviously I was constrained with getting a job somewhere. So a lot of people ask, they may talk about or ask me, what's my opinion about a state that they want to retire to? What would be a good one? And it's like, well, that's difficult to answer because I would want to retire in a state that I like living there. And a lot of people, I think, overweight how much the cost of living is. So it depends on your circumstance and situation. I think Colorado is the best mix of all of it. Cheap property taxes. When I first moved here, the home prices were very affordable. I would say the average home price, which was in 2011 when I moved here, was probably 200 and something $1,000. And the cost of living is good and the taxes are not bad. I think it's kind of in the middle. Scrolling down to Stephen, he says the U.S. LNG export plant is slated to begin production in mid 2024 for natural gas. Venture Global requests approval to cool down Plaquemines, a key step before exports. This will be the 8th LNG plant in the U.S., which becomes the world's top exporter last year. So we've got one coming online here mid 2024. So natural gas is really cheap right now. And we've got this LNG plant slated to begin production mid 2024. So this is where we could start getting some more takeaway capacity. We'll see how that impacts the inventory levels. Higher gas prices inbound, and he's not talking natural gas, he's talking about gasoline. Crude oil futures, you can see a potential line coming through here, a breakout potential retest that we've got going on, and it looks good to try to move higher here. So crude oil doesn't look that bad, but again, we'll see if we get the follow through. And I think we will. We're coming into summer driving season coming up soon, and everything looks pretty good at this time. Where are the taxes the highest? It says, what do you notice? California, Hawaii, New Jersey, Oregon, Minnesota, New York. I think they're all blue states, aren't they? Or the majority is blue states. I know Minnesota, New York, New Jersey is. California is. I don't know what Hawaii is, and I don't know what Oregon is, or blue or red. But they're all pretty hot taxes. I used to live in Minnesota, and I used to live in California. When I came to Colorado, people are like, "Isn't it expensive here?" And I was like, "Not really." I came from California, and when I first started working in 2004, I worked at a large aerospace company in Huntington Beach, and I was renting there. And my rent back in 2004, I think it was 1,080 or 1,100 or something like that. And it was a one-bedroom apartment, and a lot of the little homes around that time frame, a small starter house that was complete garbage, 700,000 bucks is what it was back then. And I was sitting there and I was making 50 something thousand bucks a year, I think. And I was like, this is bad. So I actually ended up moving back to Minnesota after working there for a year, just because of the cost of living and taxes. XOP is in a bullish uptrend by consistently setting higher lows. The chart shows increasing confidence among buyers as they are willing to buy at higher prices after each pullback, viewing these dips as buying opportunities. Currently, XOP is forming a long, symmetrical triangle, a pattern that suggests a period of consolidation with potential for a significant breakout. The longer the price high bases within the triangle right under resistance, the more momentum builds up, enhancing the potential impact of a breakout. It's key for the bullish setup that XOP maintains its higher lows and holds above 150. Successfully doing so could lead to a powerful upward breakout, confirming the ongoing bullish sentiment in the market. Yes, we are about to break out here, guys. We hit our head on a little bit of resistance here, and I do think that we will break out. XOP is the oil and gas exploration production ETF. We are seeing some of our individual companies on the website ripping it. So I do think that we are going to break here. I think it will be a monster move. And hopefully you guys are participating in the oil and gas sector and energy service because we are about to break out. Coming on back, we've got XOP again. Oil and gas explorers, a break of 175, 180 is it's a runner. Neckline, so he's got it charted from a little bit longer, bigger perspective. And this is what I prefer to look at. It's got a shoulder, a head, and a shoulder. And we're trying to break the neckline where he's got it drawn. The short term here, if you zoom in on the right-hand side of this or over here, that's what this is. And we're trying to break on the shorter term. So this is the alignment and the confluence I look for in potential investments. I want the short term to break, which will initiate and engage a longer term neckline break, which is going to set us on fire to the upside. And hopefully that comes. This is a gigantic head. And if you're to project this up, it goes to a land far greater than where we are at today. It goes way up there. So that's where I've got a good chunk of my money is in energy. Game of trades, one big market risk we're keeping a close eye on is oil. Rising oil prices due to geopolitical tensions could lead to larger market correction. I don't think you need geopolitical tensions. I think it just means rising oil prices could lead to a larger market correction. That's the way I would write it. Similar to instances from 22 and 23, it says, but this is not our base case for now. It is for me. I actually think oil is going to break out here, and I think we're going to run. That's kind of what I think. Now, does it matter what I think? It doesn't. The market's going to do what it's going to do. So he's got oil going up and S&P 500 going down, and I would say that's due to increasing interest rates. And when you look at the interest rate chart, it's broken to the upside, and the dollar. So the dollar and interest rates are suggesting and aligning with higher oil prices. And if we get higher oil prices, that is aligning with a breakout of XOP and these other charts that we're seeing trying to break out. It's all in alignment. And that's what I look for potential investments. SILJ, our boy SILJ. So SILJ has recently shown promising bullish signals with constructive bullish candlestick patterns over the last 2 weeks. Initially, there was a solid retest of her prior support. Last week, despite opening lower, gapping down, SILJ closed the week strongly with a bullish engulfing candle that covered the losses of the previous 2 weeks. This pattern suggests a strong buying pressure and a potential reversal of the last 2-week downtrend. The trading strategy for SILJ is straightforward. Watch the key levels of support and resistance. Close below this established support could indicate a bearish trend with potential for further declines. So let's just look at the chart. So I don't think we're going to get declines, guys. And this is why I don't think we're going to get declines. I mean, look at the chart here. And what I look for is I look for bullish patterns here. In 2023, we started to create these big green candlesticks and the small red candlesticks. Came back to where it was here. Lots of the times it's a double bottom or a bottom that occurs here. Boom, 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 boom. An impulse move higher with small selling pressure and a bullish engulfing. This is going higher in my opinion. It's going higher, boys. And I hope that's what occurs. Hopefully we go higher for SILJ. It looks really good. Coming on back. Uselink with COPX. The copper miners sure do look good. Look like it wants to break down a wall and go for a run. So I wouldn't say break down. It wants to break out to the upside. So we're right up against this wall of resistance is what he's referring to, and we're ready to break to the upside. You can see that volume down there too. See that volume? That volume's kicking up. We're going to break here, guys. And I think energy is going to go with it. I think silver is going to break up. I think gold's going to keep going. I think copper is going to run. Even a lot of the other commodities. Coal looks good. Nickel is breaking to the upside. Aluminum has broken. It might have a little bit of pullback in the short term, but we're seeing a lot of things break and the volumes are kicking up. All very important. Here's the highest net increase in operating coal capacity since 2016, 2/3 in China, also in Indonesia, India, Vietnam, Japan, Bangladesh, Pakistan, South Korea, Greece, and Zimbabwe. So the global operating coal fleet grew further, including rise outside China for the first time since 2019 as retirements have slowed. So coal's growing. We're adding coal. Look at this. We came back down here in late 2010s, early 2020s, and we've moonshotted higher in 2023. So what's going on here, guys? I thought we were going to get rid of coal. Maybe the energy demand is so great that we are going to burn absolutely everything we can. Ding, ding, ding. That's my opinion. Markets and mayhem. It says economic stimulus in China could boost inflation in the United States. So stimulus in China would be unwelcome tailwind for the US CPI. Keep in mind we went through China went through a housing collapse. Credit was destroyed. And they're at the beginning of their low inflation, low interest rate period. It's a recovery phase in real estate. So that they did go through a bubble. We are not in the same situation as China right now because we have a demographic, low inventory. It's completely different. This year, that's generally where tech stocks do real well. If you want to know what does well in that type of market condition, commodities will also strengthen, and the demand for commodities will go up for China after they recover from this credit deleveraging event. Idaho Outlaw says this is the everything crash people, not just housing or stocks, everything. Guys talking like silver and gold will go up 10 or 20% are still too married to the idea that the dollar is what it was over the past century. Those days are gone. It's going to be biblical. And I'm trying to figure out when people say this is the everything crash, I'm not 100% sure that I view eye to eye with maybe their opinions. A lot of people think that everything's going to crash. Do you think in history that they're just going to let this crash? I don't know. I think they're going to print like heck, and I think they're going to push the inflation button, and I think they're going to try to inflate their way out of it. So I'm in the inflation camp. I think they're going to hit the inflation button like they have in history. I don't think they're going to let everything crash in a deflationary type crash. So that's my opinion there. I think that they're gonna hit the inflation button. Gold, silver. He says we will go to unobtainium as cliff high calls it where you can't buy silver at any amount as the bankers crash. And he's got silver there with unobtainium. That's Bix weird. Yeah, we'll see. We'll see. I've got enough silver. I'm happy. And I've got platinum. Unobtaina platinum is what I've got. It says, when it comes to long-term investing, doing less is often more. And I agree with that. The more money that I make and have made has been because of longer holding periods. So when it comes to long-term investing, doing less, playing with your portfolio less is often more. Totally agree. Rick Roll says the amount of mining that is required to supply the critical elements for energy transition and battery storage will blow people's minds, especially the environmental community. Yeah, I don't even think we're going to do the transition, guys. Not in the way and the quantities that people think, because we're gonna get tight in the metals. In the U.S., both monetary base and the broad money supply are increasing again. They bottomed in 2023 despite ongoing Fed balance sheet reduction, mainly due to Treasury's duration shortening, which helped pull capital back out of reverse repos, and back into the banks. So M2 and monetary base are back increasing again. And maybe we'll get inflation from that. Here's XLE, another chart of the energy and exploration production of energy. And it looks to me like we've broken to the upside already. So this is another view, XLE, which is a little bit different than XOP and some of those other ones that we were looking at. That's already broken to the upside. It's ready to run, guys. Run, Forrest, run. So Margin of Safety is an incredible investing book, but used copies are $1,200. So let's take a quick look at these lessons. Markets are volatile. Never invest unless you are sure of a margin of safety exists. And that's the ratios I use. That's how we know it's cheap. Focus on the intrinsic value of an investment. Only act when there's a meaningful difference between value of the business and price of the stock. Focus on the downside first. Avoid taking big losses. Disciplined analysis, thorough research, and a patient, long-term perspective lead to superior returns. Value investing isn't easy. Expect long periods of underperformance. Investors focus on fundamentals. Speculators buy, sell based on price movements alone. Be an investor, not a speculator. You must become an independent thinker. Avoid the herd mentality is essential, but it is very difficult to perform. Take advantage of Mr. Market's mood swings. Exploit market inefficiencies wherever possible. Stock prices do not always reflect business reality. Know the difference between the price and the value of so price of the stock and value of the business. The stock market is not a place to expect quick money. Play the long game. Markets move in cycles. Study market history to understand and exploit them. Understand why big investors underperform. They are paid to gather assets, not beat the market. Market conditions change. Investors must continuously learn and adapt as you go through the cycles. And we've gone and I've trained to this. This fractal is what I call it. Don't take unnecessary risks. Volatility is not risk. Know the difference. Aim for consistent returns. They are superior to volatile returns. Prepare for the worst. Bad times are always around the corner. Be patient. Wait for the fat pitch. There are no called strikes in investing. Be a bottoms-up investor. Focus on individual businesses, not the big macro. Valuation is hard and imperfect. Roughly correct is better than precisely wrong. Charlie says, some of the worst business decisions I've seen came with detailed analysis. Higher math was false precision. They do that in business schools because they've got to do something, says Charlie Munger. So there's the top 20 lessons there. Commodities may become the best performing asset class over the next 20 years. The future dominance of commodities as an asset class in the investment world could well be focused on the next 2 decades. I prefer fundamental analysis over technical analysis and studying concrete data. He goes into this, but let's look at this chart here. I don't want to read all that. U.S. Commodity Price Index, 10-year rolling, CAGR, that's basically annual growth rate. So when we look at this, we've got a potential cycle here, and maybe that goes all the way up to 2045 even, potentially. And we were at a bottom here in the late mid 2010s, early 2020s for commodities there. Looks really good. Mortgage-backed securities just saw a weekly inflow of $2.2 billion, the largest inflow in history. That's interesting for mortgage-backed securities. That is very interesting. And that's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys like. LEAP is the coupon code. And that's all I've got for today, guys. So we'll catch you later. This is Finding Value.